Let's take an unusual slant on the stock market, and it's something that I know you have a good insight to. Talk to me about the origins of Wall Street and the Dow Jones and the S&P 500 and even the NASDAQ.
Yeah, those are terms that are thrown around all the time in the media, and they're never explained. Like the media would just say the Dow Jones was down 400 points today, assuming that people understand what the heck the Dow Jones is,
Yeah.
what a point is, and is that good? Is that bad? Never put it into context. However, if you go back and understand how the Dow Jones was created, why it was created, it just makes so much more sense. So investors have been, there have been publicly traded stocks in companies for hundreds of years, right? You need to raise capital from lots of investors to fund business operations, things like banks, very expensive to get off the ground, railroads, very expensive to get off the ground, boat expenditures, things to get off the ground. So raising money from investors to fund business potential is nothing new. This has been happening for hundreds of years. And just over 100 years ago, just like today, there were publicly traded companies that were out there. However, in 1896, the head of the Wall Street Journal, his name was Charles Dow, and he was reporting on what was happening in the stock market every day to his readers. Right, some stocks would be up, some stocks would be down, and for the next 80, 90 years, the dominant way that people got information about the stock market was through newspapers. However, he had a problem. He wanted to be able to summarize what happened in the stock market that day and kind of give readers a feel for what happened in the market. There wasn't an easy way to do that because some stocks were up, some stocks were down. But there's no way for him to give a quick explanation to his readers for here's what's happened. So he went to his business partner, whose name was Edward Jones. So Charles Dow and Edward Jones. And they came up with a really elegant, simple solution. What they did was they added up the share price of 12 of the most popular stocks at the time, which were largely industrial companies, so big manufacturers. So they added up the share price. That information was readily available. And then they divided the total by 12. Now, when you add up 12 numbers and then divide by 12, that's called averaging. That's getting an average. So they gave birth to the Dow Jones Industrial Average, and they calculated this number every single day. And suddenly, investors could compare one day to the next, 1 week to the next, 1 year to the next. And it gave investors data that they could use to figure out what was the mood of the market on that particular day, week, or year. Now, gradually, the Dow Jones Industrial Average caught on with investors and became more and more popular over time. And a couple of decades later, a company called Standard & Poor's decided to launch their own index to compete with the Dow Jones Industrial Average. Now, they launched a few different versions of it. The version that we know today uses 500 companies to track. That's diametrically opposed to the Dow. The Dow uses 30 companies today, more than the original 12, but the Dow still just uses 30 companies. And a lot of investors don't like using the Dow because the Dow still uses the dollar price of a share to figure out how much the index moved up or down. Well, that is not all that useful of a number, especially with today. The more valuable metric is what's called market capitalization. So the S&P 500 uses 500 companies, and it uses the market capitalization to figure out what is happening in the market on any given day, week, or year. So that's how these terms came to be. They were a way to summarize what happened in the market for their investors. And now we have the Dow Jones Industrial Average, still around today, the S&P 500, that's the more popular one, and for good reason. And finally, we have the NASDAQ. And the NASDAQ is an electronic stock exchange that was given birth in the 1970s, but similar idea. The NASDAQ composite summarizes what's happening with the stocks trading on that, and we get one number that gives us a summary of that.
Brilliant.